Imagine waking up one morning, checking your phone, and seeing a notification that says, "You've been paid," not from your job, not from a client, not from selling anything, just paid because you own a piece of a company. For many Americans, this isn't a fantasy. It's a system quietly working in the background, month after month, year after year. This system is called dividends. Most people believe the stock market only makes money one way: buy low, sell high. That belief keeps millions of people stressed, glued to charts, worried about crashes, and afraid of timing the market wrong. But there's another side of investing that doesn't get nearly enough attention, a side where you don't have to sell anything to get paid. You simply hold. When you buy a stock, you're not just buying a symbol on a screen. You're buying ownership in a real business. That business sells products, earns revenue, pays expenses, and if it's run well, produces profit. Some companies choose to take part of that profit and share it with their owners. That payment is called a dividend. In the United States, dividend-paying companies are everywhere. Some of the most boring, least hyped companies are quietly sending checks to shareholders every single quarter. Companies that sell soda, toothpaste, paper towels, fast food, electricity, and insurance. These businesses may not dominate headlines, but they dominate consistency. And consistency is where real wealth is built. Here's where it starts to get interesting. Let's say you own 100 shares of a company that pays a $1 dividend every quarter. Every 3 months, $100 shows up in your account. You didn't work extra hours. You didn't negotiate a raise. You didn't even log in. You just owned the stock. Now imagine owning multiple companies like that. Suddenly the stock market stops feeling like a casino and starts feeling like a paycheck system. This is why many long-term investors in America care less about daily stock prices and more about cash flow. They don't panic when the market drops. In fact, many of them get excited because lower prices mean higher dividend yields and more shares bought with reinvested income. Dividend yield is simply the income you earn relative to the stock price. But smart investors don't obsess over chasing the highest yield. They care about whether that dividend can survive recessions, inflation, and bad years. Anyone can pay a dividend once. Only strong companies can keep paying it for decades. This is where the mindset shift happens. Dividend investing is not about getting rich fast. It's about building a machine that pays you slowly, then faster, then almost automatically, especially when dividends are reinvested. When you reinvest dividends, they buy more shares. Those shares pay more dividends. Those dividends buy even more shares. Over time, money starts compounding in a way that feels unfair until you realize it's available to anyone patient enough to let time do the heavy lifting. Many Americans who start dividend investing early don't notice much progress in the first few years. The income feels small, almost disappointing, but somewhere down the line something changes. The snowball gets heavy, the payments grow, and suddenly the income feels real. This is why dividends appeal to retirees, long-term planners, and people who want freedom more than excitement. They don't want to guess what the market will do next week. They want to know that no matter what happens, their money is working quietly in the background. Of course, dividends are not guaranteed. Companies can cut them. Markets can change. Bad decisions can destroy even great businesses. That's why knowing how to choose the right dividend stocks matters, more than knowing what dividends are. And that's where the real strategy begins. Most beginners make the same mistake when they first discover dividends. They look for the highest number, the biggest yield, the fastest payout. On paper, it looks smart. In reality, it's often dangerous. A very high dividend yield is usually a warning sign, not a gift. It often means the stock price has fallen because the business is struggling, and struggling businesses don't pay dividends for long. Experienced investors think differently. They care about history, not yesterday, not last month, decades. They look for companies that have paid dividends through recessions, market crashes, inflation spikes, and economic uncertainty. In the U.S., some companies have increased their dividends every single year for 25, 30, even 50 years. That kind of consistency doesn't happen by accident. Another thing smart investors watch closely is how much of a company's profit is being used to pay dividends. If a company is paying almost everything it earns, there's no margin for error. One bad year and the dividend is gone. Sustainable dividends leave room for growth, debt payments, and future investment. This is why dividend investing often feels boring. No hype, no adrenaline, no viral stock tips. Just businesses that quietly keep the lights on, pay employees, and reward shareholders. Over time, boring starts to look brilliant. Taxes are also part of the equation. In the U.S., most dividends are taxed at favorable rates compared to regular income. And when dividends are earned inside retirement accounts like a 401k or IRA, taxes are often deferred or eliminated entirely until withdrawal. That small detail alone can dramatically increase long-term returns. For people who don't want to analyze individual companies, dividend-focused ETFs exist for a reason. They bundle dozens or hundreds of dividend-paying companies into one investment. Lower stress, lower risk, steady income. Many Americans build entire retirement strategies using nothing but dividend ETFs. But here's the part most people don't talk about. Dividend investing isn't just about money. It's about psychology. When your income comes from ownership instead of effort, your relationship with work changes. You feel less trapped, less desperate, less reactive. Even small dividend income creates mental breathing room. Some people use dividends to pay bills. Others reinvest everything and let it grow. Some aim for the day their dividend income covers rent, groceries, or healthcare. That moment, when your money starts paying for your life, is powerful. The truth is, dividends won't make you rich overnight, but they can make you wealthy slowly, predictably, and sustainably. And in a world full of financial noise, that quiet reliability is rare. The stock market doesn't only reward traders, it rewards owners. And dividends are proof. They're proof that you don't have to sell your assets to benefit from them. You can hold, stay patient, and let time and discipline do the work. Because real financial freedom isn't about timing the market perfectly. It's about building income that keeps showing up, whether you're working, sleeping, or doing nothing at all.